After studying this module, you shall be able to know the objectives of global cash management, learn the investment choices with transaction costs, identify borrowing choices with transaction costs, international dimensions of cash management, evaluate advantages of centralized cash management, analyze disadvantages of centralized cash management, learn technique of optimizing cash flows, identify the difficulties in optimizing the cash flows. To begin with, when it comes to a multinational company, it has inflows and outflows of funds and sales and purchases throughout the world. In that case, a firm has to maintain certain amount of liquidity. Now, liquidity can be in various forms such as currency, bank deposits, overdraft facilities and short-term readily marketable securities. The various forms of liquidity calls for the international cash management. Management of liquidity is a tricky for an MNC because its subsidiaries have access to various means of credit and various banking overdraft facilities. Liquidity ratios of such subsidiary cannot give a complete picture about the liquidity of an MNC as a whole. Thus, it becomes important for an MNC to maintain adequate cash balances even in its subsidiaries. Managers must have complete knowledge about investing the excess cash internationally through global markets. For global cash management, it is important to understand the important role of exchange rate fluctuations. Working capital management is a broader term which includes the cash management. The finance managers have to manage their working capital, which includes bills, receivables, stock and cash. In case of multinational companies, management of working capital becomes even more complex because every subsidiary needs to have an adequate working capital for its operation. Next, we will discuss about global cash management. Cash management helps in allocating the short-term investments and cash which is invested in currencies and countries to increase the corporate returns. Second, to achieve minimum cost by borrowing in different money markets across the globe. Third, cash management is done with the objective to maintain the required liquidity and at the same time minimizing any risk that ought to occur. Cash management helps to invest the excess cash in order to meet the deficiency in cash. Fifth, cash management helps in maintaining the temporary working capital deficiencies within various subsidiaries of a parent company. Now we will discuss about investment and borrowing choices with transaction costs. The choices regarding numerous currency and country choices creates an extra dimension of international finance, which increases the choices between investing and borrowing the cash. The other concern for the multinational company arises in the situation where a company has concern regarding local and head office cash management and how to minimize taxes, foreign exchange transaction cost and political risk. So, cash management in an international framework has various dimensions. In this part of module, we will be discussing whether a company should invest or borrow in domestic versus foreign currency, and where any foreign exchange risk is hedged using foreign exchange contracts. Next, we will talk about investment choices with transaction costs. By taking a hypothetical example of an investment in UAE, first a purchase of spot dirhams. The spot dirhams must be bought at dirham offer or ask rate. Spot into dollar per ask rate of dirham, so that $1 will buy dirham into 1 by spot dollar per ask rate of dirham. The initial investment will grow in n years at the investment return of R1 dirham. It can be represented as dirham into 1 by spot dollar per ask rate of dirham into 1 plus return on dirham. This can be sold forward at the buying or bid rate on dirham, Fn into dollar per bid rate of dirham, giving a US investor after n years dollar into Fn into dollar per bid rate of dirham per spot rate into dollar per ask rate of dirham into 1 plus return on dirham raised to power n. The amount received from $1 invested instead in US dollar dominated securities in n years at an annual rate R dollars is dollar into 1 plus return on dollar whole raised to the power n. Hence, the rule for the holder of US dollars is to invest in dirham securities when forward rate of dollar per bid rate of dirham by spot rate of dollar per ask rate of dirham into 1 plus return on dirham whole raised to the power n is greater than 1 plus return on dollar whole raised to the power n. We will discuss about borrowing choices with transaction costs. When a borrower considers using swap to raise US dollars by borrowing dirhams, the borrowed dirhams must not be sold at the dirham's selling rate, spot into dollar per bid rate of dirham. For a dollar, the dollar borrower must therefore borrow dirham into 1 by spot rate of dollar per bid rate of dirham. The repayment on this number of borrowed dirham after n years at R dirham per annum is dirham into 1 by spot rate of dollar per bid rate of dirham into 1 plus borrowed rate of dirham whole raised to the power n. This number of dirhams can be bought forward at buying rate for dirhams, forward rate of dollar per ask rate of dirhams, so that the number of dollars paid in n years for borrowing $1 today is dollar into forward rate of dollar per ask rate of dirham by spot rate of dollar per bid rate of dirham into 1 plus borrowed rate of dirham whole raised to the power n. Alternatively, if $1 is borrowed for n years in US dollars at the borrowing criterion that allows for foreign exchange transaction cost is that a borrower should obtain dollars by borrowing hedged UAE dirhams, that is through swap whenever. Forward rate into dollar per ask rate of dirham per spot rate of dollar per bid rate of dirham into 1 plus borrowed rate of dirham to the power n is smaller than 1 plus borrowed rate of dollar whole raised to the power n. In the case of borrowing foreign currency is discouraged because when foreign funds are raised abroad, lenders may charge more from foreign borrowers more than they charge from domestic borrowers because they consider loans to foreign borrowers riskier. This may be due to difficulty in collecting loans from foreign borrowers or due lack of credible information about foreign borrowers' creditworthiness. We will talk about international dimension of cash management. When a multinational firm has different divisions with various countries and has accounts receivable and accounts payable and other sources of cash inflows and outflows, and at times there is a problem faced by a multinational firm where one division is hedging long dollar position and the other division is hedging short dollar position with the same maturity. This situation can be avoided with the help of netting, which means doing some calculation to create some coordination of cash management. The coordination can also be done with the help of practice known as leading and lagging. Leading and lagging involves the movement of cash inflows and outflows forward and backward so as to take the benefit of delaying taxes by delaying income. Pooling occurs when cash is held as well as managed in a central location, but can be moved from that central location to where it is required. Every multinational company has an option either to manage its own and its subsidiaries' cash or let every subsidiary to manage the cash inflows and outflows of its own. The methods of having cash management are centralized and decentralized cash management. We will discuss here about centralized cash management. The centralized cash management is the system where an MNC manages its own cash inflows and outflows as well as cash inflows and outflows of its subsidiaries. Whereas in decentralized cash management, each subsidiary manages its own cash inflows and outflows. Multinational companies have huge amount of cash inflows and cash outflows in different currencies. Due to this fact, each currency balance of cash inflows and outflows doesn't matches in a particular period. Thus, in centralized cash management, where parent and subsidiary and inter-subsidiary cash inflows and outflows gets matched of the same currency without having large investments in cash. In centralized cash management, the parent company takes the excess cash from its subsidiaries and invests that in short-term securities, long-term projects, sources of debt and stockholders, and parent company in return gets return on these investments, which helps the parent company to cover the deficiency of cash in a particular subsidiary, and through these investments, parent company gives interest to those subsidiaries who have given their excess cash to the parent company. Centralized cash management not only involves pooling of cash from its subsidiaries, rather it involves the smart investment of cash to meet the unforeseen cash deficiency of its own and one of its subsidiaries. We will be discussing advantages of centralized cash management. Centralized cash management allows netting of long and short positions in each currency where the positions are different of different divisions of a multinational company. Centralized cash management provides an ability to consider how exposure to numerous rates provide natural diversification. Centralization permits a broad view of investment and borrowing opportunities. Centralization reduces the precautionary cash needs via pooling, whereby funds can be moved from central location to where it is required. Centralization helps in accommodating the cash shortages because it facilitates the transfer of the cash from those subsidiaries who have excess cash to those who are cash deficient. It can be in the form of loans given by one subsidiary to another. The centralized cash management allows the monitoring of the cash positions of each of its subsidiary. This way of monitoring helps in preventing finance managers of foreign subsidiaries to waste excess cash. Centralized cash management serves as an internal control mechanism where the subsidiaries themselves have a check on themselves because the deficiency in cash may depict the weakness of management of a particular subsidiary. We will discuss the disadvantages of centralized cash management. If there is a centralized cash management and there is an important payment due, for example, it is a payment for taxes made to the foreign government, in this case, excess cash balance should be held where there is needed. Thus, there comes the need to have decentralized cash management. The other situation arises when the cash is required in local currency to be paid and delay cannot be made, then centralized system of cash management proves to be a hindrance. Dealing with the banks in a centralized system of cash management can be a good practice, but the delays can be faced in banks in certain countries could be long and hence costly. Complete centralization of management can pose a difficulty because a local representation is necessary to handle local clients. Thus, it could be said that a firm must decide on the degree of centralization of cash management and cash holding it has to practice in order to overcome limitations of centralized cash management. There are various techniques through which a multinational company can optimize its cash flows. Those are minimizing the cost of converting the currency. Technique used to reduce the conversion cost through centralized cash management is netting. Netting can be both bilateral or multilateral. When netting is done within parent and subsidiaries or within subsidiaries and subsidiaries, it is bilateral in nature. And when netting is complex in nature, where interchange is done between parent and various subsidiaries, it becomes multilateral in nature. For example, subsidiary A does transaction in euro and subsidiary B does transaction in dollar. Now, whenever these subsidiaries need to make a purchase from each other, they will require to convert euro into dollars or vice versa, thereby increasing the conversion cost. Thus, through netting, both the subsidiaries will check the net payment to be made to each other at the specific point of time. By this way, they will have to pay only conversion cost on one transaction, that is the net balance. Increase in the cash inflows. Global cash management aims in speeding the cash inflows. The more fast would be recovery of the cash inflows, more would be the rate and frequency of investment. Multinational companies started up using various techniques such as lock boxes and pre-authorized payments through which payments can be received within less time. Managing cash transfers within subsidiaries. Centralized global cash management helps the subsidiaries to manage the cash transfers effectively. The techniques adopted in having an effective management of the cash are leading and lagging. These can be explained with the help of an example. Subsidiary A has an excess cash, whereas subsidiary B has deficient cash. Subsidiary A has to make purchase from subsidiary B. In this case, subsidiary A can make an early or advance payment to subsidiary B. This is known as leading. On the other hand, if the subsidiary A has made a sale to subsidiary B, in this case, subsidiary A can delay the date of receipt of payment by subsidiary B. This is known as lagging. Managing the blocked funds. If the government requires to uphold the transfer of the funds to the parent company to increase the employment or investment in the country, the multinational firm can adopt various techniques such as transfer pricing. Transfer pricing is a technique in which the company shows inflated expenses such as inflated purchasing price on which subsidiary made a purchase from parent company. In this technique, subsidiary is not showing transfer of the funds directly. However, the funds are getting transferred to the parent company indirectly by the name of purchases. Another technique is setting up of research and development unit in the cash surplus subsidiary, through which the benefit of research and development can be transferred to all the other cash deficient subsidiaries. Other technique could be where the subsidiary can be asked to obtain finance through the local banks and not from the parent company. By this technique, the parent company will become free from the burden of financing that subsidiary. We will discuss about difficulties in optimizing cash flows. First, work culture of the organization. At times, if a subsidiary makes delay in making the payment to another subsidiary, in that case, the other subsidiary will be forced to take loan until the payment is received. In these cases, it becomes difficult to optimize the cash flows for all the subsidiary because poor and inefficient working of one subsidiary disturbs the cash management of other subsidiaries too. Second is government preferences. Some governments have the preference towards increasing investment in their country in order to increase the employment. Thus, they restrict the transfer of the funds. Some governments restrict the conversion cost to be paid on net balance, that is, on netting, which are the cause of hindrance in optimizing the cash flows. Feature of banking system. The working of the banking system has a great impact on the optimization of cash flows, as some banks do not allow cash transfers among some countries. Some banks don't allow to keep zero balance account even for a short while. While some banks don't have the provision of the lock boxes, thus making the optimization of cash flows a difficult task. To conclude, we have learned about the meaning of cash management, the objectives of global cash management, various international dimensions of cash management, investment and borrowing choices with transaction cost, pros and cons of centralized cash management, techniques of optimizing cash flows, and difficulties in optimizing the cash flows.